the benefit of working with really strong advisors on every side is you never want the buyer to feel that they discovered something, that they were actually the ones that dug up the dirt. I think a lot of sellers take the approach in deals of, oh, we'll just let them, do the work of finding it. But the problem with that is the optics of that actually make you look less transparent. And if the buyer is considering purchasing your business, especially if there's like an earn-out component where you're going to like stay with the business, every negotiation is about relationship. And so the health of the relationship is actually incredibly important.
Hey everyone, welcome to another episode of Humans of Flippa. Today I have with me Omeed Tabiei, who has a really diverse background in working with and on his own companies, working with companies at several different levels. First as a lawyer, providing legal counsel during fundraising and exit events for several companies. The first one notably being Elon Musk's Hyperloop. And he's also raised funds for and launched his own startups. And I just think Omeed has a really valuable perspective of working at companies at the high level where the stakes are high. Being buttoned up during these phases is crucial, but also understanding what fundraising and exiting on a smaller level looks like, perhaps more relevant to this audience for those who might be raising funds or exiting for the first time and you just want to do this the right way. Currently, he helps SaaS businesses in particular through the process of fundraising or exiting. So if you're a SaaS owner out there thinking of either of these options, I think this is worth a listen. So on that note, Omeed, welcome to the show, man. How are you doing?
Hey, I'm doing well. I'm excited to be a human of Flippa. I love Flippa.
I'm excited for you to be a human of Flippa.
And I love being a human, so here we are.
But what is human? Just to start that off.
Man, all right.
No, I'll before we potentially get into that direction, I know I provided just this quick summary of you, but can you tell me just a little bit more about you, your background, anything that you want to share?
Yeah, I mean, you covered it pretty well. In terms of humans go, like I'm a pretty like complex and layered human because I don't fit into like any specific box. So I've worked as a lawyer at some of the top startups, at some of the top law firms, top accelerators, always in the software space, 10 years as a lawyer in the software space. And I'm also one of those people that's crazy enough, like where I saw these people doing cool stuff and raising a whole bunch of money. And I was like, oh, I could do that. And then quickly learned like, oh, it's not as easy as it looks. But along the way, like really discovered that I just love building things. So like the typical traditional, associate to partner pipeline was never something that I wanted to follow. And as a result, like I've had a great adventure of a career.
Can you tell me about your experience with Hyperloop or just providing legal counsel?
Yeah.
What that, what that was like being at the table with, during these fundraising conversations or exit conversations, and then to your own thing and kind of what that experience was like?
Totally. Yeah, I mean, Hyperloop was a really interesting experience. So for all the listeners out there, I'll just give you like a quick bio, like, just to fill in the gaps if you, didn't get it from Nick. So my first job was corporate counsel at Hyperloop. It was the Virgin Hyperloop One. So it was ideated by Elon Musk, but, Richard Branson ended up being the chairman of the board for a period of time. I helped them raise around $150 million. When I came in, they had initially, raised an initial round of 10 million. And when I came in, the 10 million that they had raised was, we had a cap table with like something like 200 people on it. So the primary investor, Shervin, he's just like super well connected because, he was managing partner at Menlo Ventures and so on and so forth. So he just called all his friends essentially and was like, hey, it's a 10K, 20K buy-in, whatever. And they just like filled the cap table with, a lot of like little investors. So what ended up happening was for the Series A, we had to go in and buy out a lot of the early investors. So that was like a super interesting event. We had to clean up the cap table pretty much, which is what the first round of funding really went to. And the first round of funding, the actual like institutional round of funding where we raised around 50 from, a handful of investors. I mean, that, process was like streamlined. Again, so much of the culture and world of raising money is about who you know and how they know you. So for someone like Shervin, it's like super easy for him to raise money. He just makes, a few phone calls. He's launched incredibly successful funds. So when he asks for money, people just give him money because they know that he's good at managing their money. And that's really what investors look for with respect to founders, which is why it's so difficult for a lot of founders to raise. Because if you don't have a track record of success, for example, with exits or being able to return for your investors, and especially if you're a first-time founder, unless like you have some idea that gets people incredibly excited because you're able to like show traction, for example, it's going to be challenging for you to raise money. So Hyperloop was my first job. The experience of like being at the table with investors was super interesting, coming into this place that like initially operated like a true startup with like a cap table of like 200 people on it, to like raising institutional investment and like purchasing and cleaning up a lot of that cap table. And then, to the Series B round, which was like easy peasy. But to going and helping to facilitate an exit as in-house counsel at this company called VER at the time. So we sold to private equity. I helped facilitate that transaction. I've always been a corporate lawyer in the tech and startup space. And then I worked for a boutique law firm. We worked for, Plug and Play and 500 Startups and Draper University and SaaS Academy and so on and so forth. Then I worked at a large law firm. And then I started my own law firm. And in between there, I also started 2 software companies and 4 other companies as well. So a lot going on in there.
Yeah. Well, let's get into what you just said about it being difficult to, as a first time, a founder raising funds for the first time, because that was you at a certain point. So walk me through that experience, that transition from what you were doing to that.
Yeah. So I think raising institutional VC capital is difficult as a first-time founder, especially if you don't have traction. I think for a lot of first-time founders, what their experience with raising capital is they, get this idea and they're like, oh my God, this is $1 billion idea. They put a pitch deck together. Maybe they hire like a pitch deck coach and, get a graphic designer, and they think that like, you put this like sexy pitch deck together and then you like email it around to 20 or 30 VCs. And that's like how you raise venture capital. I'm literally actually speaking about myself right here. That was me. Like when I started my first startup, which was an AI computer vision app, I thought like, okay, we'll put like, this cool pitch deck together. We'll get, a talented designer, like, in the 2010 period to like 2015. And again, in like, 2021, 2022, raising off of a pitch deck was a thing. Like you could absolutely do that. You just back then they called it vaporware. Everyone was building, vaporware, or they were just building vapor. You put together like a sexy pitch deck, you get it in front of some investors, you get some warm intros to investors, and, you raise like a ridiculous like $2 million round off of, just a pitch deck and an idea. That's what I thought it was like. And so I put this pitch deck together and I go and I like talk to all these VCs, and then all of them are saying no to me. I talked to like 20 or 30 VCs. I'm spending all of my time trying to raise capital from these like institutional VCs, and all of them are either like, oh, too early, not my industry, not a strong enough team, for example, or whatever, right? We don't invest in pre-revenue startups. Like whatever excuse that they can think of. It was just like an excuse generator. They just like push the little button and an excuse pops out. Okay. And then I got real, and it was like with my co-founder. My co-founder happened to know a bunch of like really wealthy angel investors because he was connected into the space, and he had personal relationships with them. So, originally I thought I was going to raise from cold investors. Then I learned.
I see.
Like, oh, no,
Yeah.
if you're a first-time founder with no experience launching startups, it's going to be incredibly difficult for you to raise from cold investment. You have to work your network. And the other thing that I believe is every investment round, this is common sense, right? Like, every investment round is proof of your ability to manage the money. So what do you do with that money will prove whether you can proceed to either the next investment round or the success of the company. Each investment is a bet that could potentially lead to the next investment.
For somebody looking to exit, since I think a majority of our audience initially are sellers looking to exit as opposed to fundraise, based on your experience with helping people prepare for an exit, things you've seen done well, things you've seen not done so well, what are a few things people need to know in preparation of an exit?
Well, an exit and a capital raise event are actually not that different. The only difference is one is for a portion of the company, which is the capital raise. The capital raise, they're buying, some most likely minority interest in the business, 10%, 20%. And an exit is 100% of the interest, or a substantial number of the assets of the company. So the only difference between a capital raise and an exit is the amount of interest that's being purchased.
What do you think are a few things people need to know in preparation of that exit?
Yeah, in preparation of the exit. So, I think what the traditional answer that most people would give in this instance is like, make sure you work with a broker, make sure you work with a lawyer, make sure you work with, an exit advisor, make sure you work with a CPA. You want to make sure, your last 3 years of financials are in place. You have your documents, so on and so forth, that you have, a good looking sim that you take to market. That's like the cliche advice, right? So I want to give something a little maybe more substantial or meaningful outside of, just like find a good advisor, which, by the way, you should definitely find a good advisor to work with. And Flippa has like a whole network of advisors. So it's like right there. But outside of that, what sellers should know about selling their business is if you started as a C corporation and you held your business for 5 years, if you held the stock of the business for 5 years, good job. You get to access something called the qualified small business stock, which is a tax exemption from capital gains tax for up to $10 million per founder or interest holder. That's huge. That's $10 million that literally goes into your pocket. So that's something that you should definitely know. Outside of that, other things that you should know are the seller's role in an exit is to set the pace of the exit. So what I mean by that is the buyer is going to try to spend as much time as possible. And if you let them and you don't set the pace of the exit and put pressure on closing the deal, the buyer will drag their feet. They will take forever to evaluate your business for the most part. That's not necessarily true for all buyers, because on the buy side, they also know that the business, every minute that it's in the sale process, is deteriorating because, the founder may be losing interest. The exit process is quite grueling in terms of what's required from the seller. And so there is a half-life for the deal itself. The adage in M&A always is time kills all deals, time kills all deals. And what we're talking about are the different variables that impact the killing of the deal. One of them is I do genuinely think that it's the role of the seller to set the pace. What that looks like is you can be quite annoying. Like, you can be like, when are we going to close this deal? Like, really pushing, on the closing of the business and being incredibly responsive. So that's, seller's responsibility, getting your lawyers teed up, making sure, your lawyers are aligned with you every step of the way so that your lawyer's not, negotiating something that you didn't intend or that you don't know about or that you didn't discuss with your lawyer, so the alignment there is incredibly important, but the seller should always be keeping the closing date in line and moving towards that closing date, because what the buyer is going to try to do, the buyer is going to try to push the ball into the seller's court as much as possible and make it look like the seller delayed the closing of the transaction. Like, oh, you didn't get this to us in time, so now we can't close on XYZ date because we've been waiting on you. Now we need this additional information in due diligence, and until we get that information, we're actually not going to close on this business. That information, for example, could be customer contracts. It could be something that emerged during due diligence with respect to the financials. Maybe, some economic event had happened in the year prior that after, the diligence has happened on the financials, it has emerged that, further diligence is needed on that item, whatever it is. The buyer is going to be discovering things during the sale process and constantly putting the ball back in the seller's court to extend the diligence process, because the buyer wants to feel that they have a really strong understanding of the state of the business. So the more that they can research, they're going to want to research as much as possible. And the deals that I've seen be most successful is where the seller is very vocal, like, are you ready to close yet? Are you going to close yet? What do you need to close? The closing date is coming up. Making sure to hit those deadlines and not be seen, because optics is incredibly important. It's like being at a poker table. Optics is incredibly important at the deal table. Who is delaying? Who is stalling? Why are they stalling? These are all variables of information that people are going to be evaluating about one another.
I think alongside the optics, or what enable you to even push that along, I think is, last time we talked about the dirt that buyers will inevitably pull up dirt on your business, just things that aren't just watertight, things in your financials, your processes, your contracts. And so I think part of probably what enables you to even be that aggressive as a seller is having those things, or what you said was like the narrative to those things that will inevitably come up.
Yeah, that's exactly right. So, the benefit of working with really strong advisors on every side is you never want the buyer to feel that they discovered something, that they were actually the ones that dug up the dirt. I think a lot of sellers take the approach in deals of, oh, we'll just let them, do the work of finding it. But the problem with that is the optics of that actually make you look less transparent. And if the buyer is considering purchasing your business, especially if there's like an earn-out component where you're going to stay with the business, every negotiation is about relationship. And so the health of the relationship is actually incredibly important. So and I think a lot of sellers don't really think about this, and I think they should think about it more. Because if you're carefully intentional with this piece, I think it'll actually result in a smoother process for you, in a better process. Your buyer is going to be happier, and ultimately, as a result, everyone is going to have a better experience in the transaction. So relationship is incredibly important. Transparency is really important. What you mentioned, the narrative around, the fluctuation in the financials, the narrative in, potential challenges with customers that may have led to the fluctuation in financials. the understanding of potential conflicts that may have arisen in the business, whether it be like IP conflicts or maybe employee conflicts or something like that. Giving the sense that you are an incredibly transparent person in a transaction strengthens the the probability that that transaction will happen, and it makes it so that
Yeah.
you avoid the risks of the transaction falling apart by being the one who presents the risks to the buyer, as opposed to having them discover it and them starting to actually question how well you know your own business, which will tank the deal.
Yeah. 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 That's great advice. And I can imagine some sellers aren't aware of all of the dirt, or they're just not used to the exiting process. They're used to the operating process or the management process of keeping the business going. But I imagine it kind of gives you a blind eye as to what an acquirer looks at from that perspective. But yeah, very good advice. So from the fundraising part, sounds like there's some similarities there as far as if you want to fundraise instead of sell your entire business. Maybe one of the first questions, aside from what you should do to prepare for that, if we want to even get there, the first question is probably, should I even fundraise? And we can talk as little or as long as you want about that. But I think we should at least touch on that first, since that is probably the first thing that even determines if we should even talk about how to fundraise. So what's your perspective on that?
Yeah, I love that question. And I'll tell you, so the way that the lawyer's role is applicable in a fundraising situation, I always give this analogy. A lawyer is like the priest at a marriage. Like
Okay.
you have identified the love of your life, who is your investor, who's going to, invest money in your company. And then when you're ready to get married to that investor, that's when you go and you see the priest, who is your lawyer, and the priest, does the little thing, I pronounce you man and wife. That is the role of a lawyer ultimately. But here's actually what's different about working with me, and there are other lawyers that are like this too. I'm, not making it seem that I'm the only one that, thinks and operates in this way. But your question of like, should someone fundraise or not, that is fundamentally a question meant for the founder. And I think most lawyers would not advise on that point, because it's actually something that the founder themselves has to ascertain and determine. And I think, but outside of that, because like I have been a founder myself and so on and so forth, I can speak to that, and I often do help founders in that respect, in terms of, just because I can talk about it, right? I can tell you like, okay, what you think about, for example, is the triple, double, for example, in the SaaS space, which means that if you take venture capital investment, they're going to expect you to triple over 2 years and then double for the next 3 years. That's what creates the hockey stick growth. So if you don't think that you can achieve that sort of growth, then raising venture capital probably is not the best approach. If you're a profitable company, there are other types of capital that you can access, for example, venture debt or a convertible note, or, there's other types of financing instruments that you can seek out outside of venture capital. But venture capital looks for a very specific thing. I was just talking to, actually, on my podcast, I was talking to John Rush, and what he was talking about was the venture capital model breaks a lot of businesses, actually, because it requires the founder to have the vision of being a unicorn. And ultimately, it's the vision of the founder that determines the direction of the company. And if you're aiming to become a unicorn and you're operating as if you're going to be a unicorn, that's a very different operating model than growing at like a safe 15 to 20% year over year growth. Right. So what I'm doing is I'm pushing the question back onto the founder to understand the implications that come with raising venture capital. It's first is the requirements of, the growth model. So, that's an incredible amount of pressure for a founder. Not all businesses are situated or made, and we see that in the market. A lot of people raise venture capital and they're not able to build sustainable businesses. They build businesses that are reliant on venture capital, and they're not able to grow at the rate that they need to sustain the business in a meaningful way moving forward. So the first thing is, like, can you hit the growth rates that are going to be necessary to make your investor happy? I've heard many people start there. I think it's a really good place to start. And it also is related to the question of, do you have a reason to raise venture capital? Like, what is your reason to raise venture capital? I think a lot of, especially first-time founders, think about raising capital from similar to like an exit event. I think an exit event can be a badge of honor. Like, oh, I've had an exit. That means, I have proven my worth as a founder. I can, I can be a founder and I can do it well. Look at this badge I got. I got an exit.
Right.
And outside of that, I think raising venture capital is also a badge of honor. I think for a lot of first-time founders, they see it as like, oh, I validated myself as a founder. And it was actually interesting because when I talked to John, one of the things he talked about, he was like, I didn't even know there was another way. I didn't even know that bootstrapping exists. I thought, like, you launch a startup and that's what you do. You just raise VC. And I do think that's true for a lot of founders. And what I often tell founders is, like, if you can make your company successful with a little money or no money, imagine how successful you could potentially be with money applied in a very intentional, specific way for a specific reason.
Yeah.
So the determination of, like, should I raise venture capital? Am I a company that is positioned to raise VC? Am I a company where does my vision for the company? And this one I think is always challenging because every founder is always like, I want to build the next unicorn, like, I think most founders like start out with that mentality, especially in the early stages. And I think that's related to the like raise VC mentality. But I think, is your company positioned, situated? Do you have that vision for your company? Is there a reason you want to raise? Is there a specific reason you want to raise capital for that will support the investment thesis of venture capital? Starting with those three questions, I think, would be a great place for startup founders.
Yeah. Yeah. Awesome. So it sounds like the controversial opinion then would be that it's about bootstrapping versus VC.
Yeah.
Is capital allocation.
Yeah, even though I've been informed that it's like not that controversial of an opinion anymore, it's okay. I like see this ongoing war happening, where people are like, don't raise VC, just bootstrap. Like, bootstrappers are like, bootstrappers united. And then, all the VC back founders are like, oh, like, VC works. Look at us. Look at all these snacks we got at our startup. It's awesome. Or whatever. But
that's probably what they say.
That's definitely what they say. In their Patagonia vests. But
naturally,
I think that in that conversation, the people that I actually would want to convince to think differently about things is the bootstrappers. So my controversial opinion is actually less maybe with the VC backed founders and more towards the people that are like rah, 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 bootstrap. And the controversial opinion for all the listeners out there is that it doesn't have to be one or the other. And I actually understand necessarily why it is one or the other. I understand, bootstrappers are like anti-VC because they're like, oh, you can grow perfectly fine. You can have a profitable business, without VC fundraising. And, oh, by the way, VCs add no value, they suck. And you give away, a healthy share of equity in your company to VCs, and they suck for that reason as well. And then on top of that, a lot of bootstrappers think that VCs just add no value, which, is up for debate. But I disagree. I think that the missing piece in that mindset is great. You grow your 15 to 20% year over year, very safe, very comfortable. Your business is profitable. And like, what would allocating capital to maybe, this new strategic plan that you've had in mind, for this new feature for some like either horizontally situated market to penetrate or vertically situated vertical to penetrate as well, wouldn't it be great to have capital in that case? And then, open an entirely new stream of revenue. I think it's about smart capital allocation. I think that's really what we should be rallying behind. I don't think we should be rallying behind one or the other. I think that it's about how do we utilize all of the tools at our disposal.
That's a great point, because it often does feel like you have to be in one camp or the other. Similar to what you said about people not knowing that there's an option outside of VC funding if you're in that world. Probably also with bootstrapping if you're not in the VC world, or if you feel excluded from that, because it does kind of feel like an exclusive who you know type of world as well. But to have something established, a foundation of what works in your business and knowing what works, and having kind of an educated bet as far as what kind of growth tactic or vertical would really kind of add fuel to the fire that already exists. Sounds like that's kind of more of the mentality, and I get that. Now you provide services specifically to SaaS founders. Am I understanding that correctly?
Yeah, I work primarily with SaaS founders, but digital assets for the most part. So any sort of digital business. We've also worked with e-com founders and hardware tech founders and so on and so forth. But passion is for sure startup founders, software founders, and that is who my law firm primarily serves.
Got it. And what size normally would somebody be at when they are ready to start a conversation with you?
Yeah. I mean, it depends, so there are three primary buckets that we operate in. So incorporation, let's say someone's like thinking about starting a business, they could absolutely come to us like at that phase, and we can get them up and running and set up and so on and so forth for success moving forward. The second bucket is VC fundraises. So if they're, considering raising capital, they would come to us to, have a conversation around raising capital. And then the third bucket is if they're thinking about exiting, whether in the short term or the long term, it would be a good idea to have like an orienting conversation with an M&A lawyer about, that exit process. So those are the three buckets that we really help with: starting your business, scaling your business, or raising venture capital, and then exiting.
Yeah. And last time, I think you even mentioned this. I'm not sure if you mentioned specifically C-Corp, but just about making sure that you're incorporating properly from the start, if there is a chance that you're going to fundraise, even if you don't know.
That's right. That's my rule. If you even think for like one instant that you're going to raise venture capital, I think starting as a C-Corp is the move.
Got it. And for those looking to fundraise or exit, how much time should they, in advance of their desired exit date, let's just say, how much time, when should they start to talk with you?
I think that starting to plan for exit 2 years from the exit event is like what a really experienced founder would do, because in that 2-year period, you can set, goals in terms of like revenue goals or operational goals, to really build the system and put in the time and effort that will be necessary to get the business to a place where you feel good about selling it, because that the target value that you're going to set, you'll actually be able to achieve.
Got it.
That's on the exit side.
2 years, yeah.
On the cap raise side, I think, a typical cap raise process is about 6 months. So when you're thinking about, starting the cap raise process, go talk to a lawyer.
Yeah, that makes sense. Okay. And do you have any resources or anything that people can use to connect with you, learn more from you and what you do?
Absolutely. Yeah. So if people listening to this, message me Flippa on any of my social media platforms, whether it be LinkedIn, Instagram, or Facebook. You can even email me. If you message me the word Flippa, I will respond. And I've got guides for sellers. I've got guides for buyers. I've got guides for raising VC. So if you send me the message Flippa, I'll ask you, what is it that you're trying to do? And if you tell me, whatever it is, I'm sure that I'll have some sort of like a guide or resource for you. So yeah, that's the best way for people to reach out to me.
Well, I appreciate that. And what for as far as reaching out to you, what links or how should people connect with you that I should leave in the show notes?
Yeah, it can be my IG, it can be my LinkedIn. Those are probably the two best places for people to connect with me.
Okay, awesome. Well, Omeed, I think we're getting close to that time, so I think I'm going to wrap up here. But yeah, thanks so much, man. I really appreciate your time.
Absolutely. It's been a pleasure to be here. Thanks, Nick.
Absolutely. Thank you to the audience out there. And thank you for joining this episode of Humans of Flippa. And we'll see you on the next one.